So let's talk about the 5 ETFs that investors need. The 5 investments you need are very simple. You need a large cap, and this is if you're in a 401k plan, your IRA, whatever it is. This is how I start with beginner investors. And I have clients who are investors for 30, 40, and 50 years who the bulk of their portfolio is still managed like this because it's effective and it's diversified. It's important to have diversification. Diversification is a strategy that we in the industry use to reduce risk. It doesn't necessarily protect your portfolio from going down in a generally down market, but it does prevent the worst part of your portfolio from becoming your entire return. So you have your large cap stocks, which are typically represented, let's say, by the S&P 500 or the S&P 100, if you just want the top 100 companies in the S&P 500. It could also be the Russell 1000 index, the largest 1,000 companies that are traded in America. And then you have a mid-cap mutual fund or ETF. Now, if you go into your 401k plan, typically you're not going to have ETFs. You're going to have a large cap fund. Usually there's a choice of different large cap funds. I like a blended large cap, not necessarily large cap growth, large cap value. I want large cap blend. And then I want a mid cap fund. And now I could tell you that iShares and Vanguard have outstanding index tracking funds for mid cap and large cap. And then I want a small cap fund. And again, I don't want small cap growth or small cap value. I want small cap blend. And then you have international, and the main benchmark is the EFA, and there's actually an ETF with the symbol EFA from iShares. But there are lots of tracking stocks and mutual funds that can give you a broadly diversified international markets exposure. And then a bond portfolio. Typically for bonds, if I'm only going to have one bond position, I want the intermediate bond fund. If not, you can always go with something like BND. That's a ticker symbol from Vanguard. That's the whole aggregate bond market, and that's okay too. I don't want to slice it and dice it, and I want to make this simple for you. I don't want to slice and dice it too much because there are thousands and thousands of different kinds of investments that do something different for your portfolio. And some of you might prefer the individual stocks, but I don't really like to get into the individual stocks until we have a foundation built. So I might say to somebody 30% in large cap stocks, 15% in mid cap stocks. So that's 45, and then 10% in small cap. So it's 55, 10% in international. Okay, that's 65. And maybe the rest in bonds. And that would be close to a 60-40 portfolio. That would be something for, I would say, somebody who's closer to retirement, who's maybe pushing up to 60s. I'm a Gen Xer, just to give you an idea of where I stand. If you want something a little bit more aggressive, you could go maybe 70, 75% large cap, and then some in small cap, mid cap, and some international, and skip the bonds altogether. But with those 5 asset classes, those 5 choices, that is typically what you need to build a basic portfolio. You can keep your expenses low. Your expense ratios are pretty low. You can use a financial advisor for that or not. If you're investing in your 401k plan, which is a self-directed plan, you certainly can pick those different sectors and just pick the most basic fund in each one that you can find. I wouldn't get overly fancy with it. So there are just 5 choices that you need to really build a fully diversified, long-lasting portfolio that would be based on your needs. And obviously, when you're younger, it's more stock heavy. As you get older, it becomes more bond heavy. I was going to say something about diversification, how this might not work or how this could work against you. Small caps and international have not really been great over the last 10 years. Large cap would have been much better. I mean, in the last 10 years, you would have been better off putting all of your money into the large cap part of your portfolio. Just only have large cap stocks, like an S&P 500 or a S&P 100 or even a NASDAQ 100. That would have been your best bet. So having small cap and international would have actually lowered your returns over the last 10 years. The reason I still include those is because I'm still a believer in diversification, and one day those asset classes will help you outperform the large cap stocks. So this is why diversification never goes out of style. It's just a compromise. And this is why there's a bond component. Listen, even growth portfolios, once somebody is like, let's say 30s, I typically could have 10% of their portfolio in fixed income, in bonds, because it's a useful place to not only help rebalance a portfolio, it's also a place where if I really need to, I can dip into that to add more, stocks, more stock exposure. So that's my lesson for today.